I'm Zoe Thomas, a partner in business tax team with focus on real estate, and I'm joined by my colleague John Voyer, also a partner in the business tax team, who's been a VAT specialist for over 25 years. This morning I'll be discussing the new rules on UK property tax for non-residents, who is affected and what exemptions are available. And John will be talking you through some topical VAT issues in property for contractors and developers. Please do feel free to send in any questions throughout the session, as there will be time for Q&A at the end. So let's begin with a look through the capital gains tax for non-UK residents. From the 6th of April this year, all non-UK resident persons will be taxable on gains on direct or indirect disposals of interest in any type of UK land or interest in UK property-rich entities. This is a significant expansion to the non-resident capital gains tax rules and represents a fundamental change in the regime. Obviously, prior to this date, only the disposals for UK residential property by non-residents was chargeable to tax following the changes in April 2015. However, the gain under the new expanded rules is chargeable to capital gains tax for individuals or corporation tax for non-UK resident entities. And the rate of tax will be the same as for an equivalent disposal by a UK resident. So that's broadly, for non-resident companies, it's currently 19%, and from April 2020, it's 17%. For individuals, it's 10% or 20% for commercial property, and 18 to 28% for residential property, depending on your own marginal rate. It is possible to elect for the historic cost to be used when calculating the gain, because what the Revenue has said is that the taxable gain will only be limited to an increase in the value arising from the 6th of April this year. But where the historic cost is actually greater than the valuation as of the 6th of April this year, you're able to use that historic cost. And we understand that HMRC will not necessarily require a formal valuation to have been undertaken at the 5th of April or whatever date you wish it to be, but we do recommend that the valuation evidence is robust in case of any challenge by the Revenue, or also in case of any disposals. And I'm sure this will be one of the points that's picked up in any due diligence questionnaires, or whenever anyone is looking through to purchase a property or through an entity. As I mentioned, it doesn't just cover disposals of direct property, but also covers closely held indirect interests in property-rich entities, and they'll also be taxable from the 6th of April 2019. So everybody is now within the regime. An entity will be property-rich if 75% or more of its value derives from UK property. For an interest to be considered closely held, it will need to be holding 25% or more at the date of the disposal, and this is also important to notice, or within a 2-year period prior to the disposal. The holding is either direct or through a series of entities connected with the main entity, and also connected party interests will also be aggregated. So I think it's important for everyone to realise that it's not just your own holding. You've also got to consider other entities within the group and also other connected parties that you are related to. What I also wanted to say is going down the route of collective investment vehicles. So there are specific definitions of what is included in CIVs, collective investment vehicles. These include UK REITs, the foreign equivalent of UK REITs, collective investment schemes as defined by the SMA 2000, and alternative investment funds as defined in the regulations 3 SI 2013-1773. What's important regarding the exemptions is that certain investors are outside the scope of the regime, such as certain tax-exempt investors as pension funds and sovereign wealth funds will be able to claim an exemption from the tax on any gains attributable to them. And also, following the changes last November, there is also a trading exemption, which is very similar to substantial shareholding exemptions, if everyone knows what that is, regarding where there is a trading business, property companies will be exempt if all or almost all of the UK land being disposed of is being disposed of in the course of a trade. So, for example, and a hotel business is a great example of this. So if you're selling the hotel and the business of running the hotel in one go, then this will qualify for the trading exemption, or should do. Now, this is a new exemption that came in from November from the consultation that was submitted, and we understand that HMRC consider it sufficient for the qualifying trade to be carried on by a connected company within the UK property rich company. So it doesn't need to be the property and the business don't need to be in the same entity. They can just be within connected parties, so within the same group. But the seller, so if you're selling, that you must have the expectation that the trade that you're currently selling as part of the overall transaction will be carried on for a significant period following the disposal. So it can't just be bought, sold as one, and then whoever is continuing it just does away with the trade, and you're only therefore just claiming the exemption in order to kind of benefit from that tax benefit. The other thing that I think is really important to notice is HMRC have responded to the property industry's concerns regarding the inequitable treatment of collective investment vehicles. So on the previous page we kind of quoted what that includes, and HMRC have therefore created a specific subset of rules to determine how the rules will apply to CIVs. And the purpose of the rules is to broadly exempt gains on the disposals made by collective investment vehicles, but to tax the investors on their disposal of the holdings in the CIV. I think it's also worth noting that CIV investors will not benefit from the 25% de minimis ownership exemption, which qualifies when we're talking about if you're holding any interest and you've got a greater than 25% holding, then if you're less than that de minimis does not qualify for CIV investors. There are two elections for CIV investors. They are the transparency election and the exemption election. I'll briefly cover these, but you will need to go into a lot more detail, and it's also worth noting that they have quite a lot of, I suppose, admin around them, so you've really got to make sure that you are electing into these, you understand what is involved, and that you're electing into the right one, so that you don't get caught by any of the requirements that HMRC are requiring you to follow. The first one is the transparency election. This enables CIVs, which are currently transparent for tax purposes in respect of income but not gains, to elect to be treated as a partnership for tax. So hence you're pushing the level of taxation to the investors. The election must be made 12 months from the CIV first becoming UK property rich. What's important is it's irrevocable. So once you're in, that's it, you can't come out. And the other key point is that all investors must agree to go into the election. So it's therefore likely that only CIVs that have got a limited number of investors and the investors don't change very often will want to elect into this transparency election. The alternative is the exemption election. Now, it's less restrictive because there are no time limits for making this election, and it's not irrevocable. However, you must satisfy one of three conditions to be able to qualify. And once the election is made, the fund manager must then also provide certain information regarding the administration and who are the investors, etc., to HMRC annually. So it does require quite onerous admin burden on the fund manager. It does not require the investor to unanimously agree to elect into the fund, but what happens is if you do elect into this and then you decide you want to come out of it, so if you do come out, it will result in a disposal and reacquisition of all the investors' interest in the CIV, and any chargeable gain that will arise will immediately create a tax charge for the investors. So although it sounds a better option because it's not irrevocable, there's no time limit, and not all investors have to agree to it, there are quite a lot of conditions and restrictions around it, so it certainly is worth investigating it further. So I think there are lots of things that people need to look at, and this is obviously just a high-level summary of those points, and just wanted to make you aware. I thought it was interesting to understand if anyone was planning to sell a property in 2019, or you're holding back just because you don't want to kind of get involved in this this regime just at the moment until kind of it's bedded down and see what the results are. So I suppose what you need to do now is obtain a valuation, or ensure that you've got the evidence to support a valuation is robust, and that it will be able to withstand any possible challenge from HMRC, or, as I said before, if there are any due diligence questions. Also, do you want to make an historical cost election? So look back at the valuations of the properties over the last few years to see if they have been at a greater valuation than they were on the 6th of April. Again, supporting information will be important for this. If you want to do this, you can make the election after the disposal, but obviously you need to make sure you've got the evidence to support it. It is important to know that any indirect disposals, so those that are through entities, if the original cost basis is used and it creates a loss, that loss would not be an allowable loss for tax purposes. And as I've said previously, HMRC will not necessarily require a formal valuation, but you will need to have supporting evidence. There are a couple of admin things, and we're still working through what they are, because the Revenue actually only released these on the 8th of April. So as of today's date, we've not kind of gone through them practically. I think the key thing to note is that a disposal of a property is not just a sale, it's also a gift of a property or a transfer. And non-resident companies that make a disposal will need to register for corporation tax purposes. And this, I think, is important because most non-residents will think, well, they're still under the income tax regime because that doesn't change until 2020. But for any disposals of property, you need to register for corporation tax in this year. So it's for 1 year. You'll be registering for corporation tax for disposals, but all of your income and your revenue will still be taxed under income tax. So that date for disposal that you need to register is 3 months from the disposal. And you'll be required to submit a return for the applicable accounting period within 12 months from the end of the accounting period. And the end of the accounting period is essentially the date of disposal. Payment for corporation tax in respect of the gain is actually quite complicated. It's not straightforward, as it never is with new rules. And essentially, in summary, there are lots of different permutations, but most people, that depending on the level of taxable profits and the length of the accounting period, it's likely tax will be payable within 3 months and 14 days after the disposal. It's still important to recognise, I suppose, existing penalties for failure to notify or for late or incorrect returns will still apply. And this is the comment I just made earlier, that rental income is still taxable under the usual tax self-assessment for this year. Next year it changes, so you may therefore require 2 tax returns, a corporate tax return and a self-assessment tax return for this year. This is just a brief summary of the changes that are coming next year. I thought it was important to touch on these because they're so interlinked with everything that's happened this year in respect of capital gains and taxing commercial property, and just kind of broadening the net of who is going to be caught by the tax rules changing. So from April 2020, non-UK resident companies, so most non-resident landlords with a UK property business, will fall under corporation tax rather than income tax, which they're currently charged. By April 2020, the corporation tax rate will have fallen to 17%. But what's really important to understand is that the way that you are taxed will also change. So things such as interest and finance charges will be treated as non-trade deficits. Expenses related to management of the company will be classified as management expenses. New rules on loss restrictions and also the corporate interest restriction rules will apply, as well as certain hybrid mismatch rules may apply in certain circumstances to non-resident landlords. It's also important because I don't know that many non-resident landlords have tagged IXBRL accounts, that they will now need to be filed along with the corporation tax return. So for next year, there will be a number of changes that you should be talking to your tax advisors too, or obviously us as well, because I think it's more of an admin burden, and you'll need to make sure that you're kind of geared up for that, because it does come in pretty quickly. We're almost, it's less than a year away now. And this is just kind of some of the transitional points that I wanted to cover, because you will be able to grandfather your income tax losses, so they should not be lost, but they will only be able to be used against the UK property business to corporation tax, so no other types of income. And you won't be able to group relieve those losses. Changing from income tax to corporation tax is not a disposal for capital allowances, so they should just continue. And the non-resident landlord scheme, in terms of whether you receive income gross or net, will still continue for offshore companies. This is also a bit of a pain, because currently you do one non-resident landlord return. In the transition year, you may have to do two, depending on when your period account is and whether it straddles the 6th of April 2020. So I think the point to note for this is that there are lots of different admin requirements that you need to look at. So I think it's worth following up, because a year will come around very quickly. To wrap up and key takeaways, I think it's important for people to understand that, as I said, non-UK resident persons will be taxable on gains on disposals of interest in any type of UK land. So that the net is very wide now. From April 2020, non-resident landlords will be taxed under corporation tax. So it's really important to understand your position, what it means for you, and if you need to do anything this year, and what the things are that you need to do for next year, April 2020. I shall now hand over to John.
Hi there, good morning everybody. I think the core principles of VAT are laid down by the EU directives, or at least for the time being anyway, which is why we don't see too many major VAT changes in the UK, because, as I say, it's dictated by Europe. However, UK property law is very specific to the UK, which does mean our UK VAT legislation is very much tailored to the way the property sector operates. As a result, most of the VAT changes that do come along arise out of case law or changes in interpretation of the rules, which does mean that property is probably one of the most complex areas of VAT, where a knowledge of current developments can be essential. For this reason, today what I'm going to do is very, very briefly run through what I think are 5 fairly topical issues for VAT and the property sector, which I hope will be of interest to you. So let's start with changes for resident management agents. About 2 years ago, over 2 years ago now, ARMA, the Association for Resident Managing Agents, approached me to point out that there was a unlevel playing field in the market, insofar as a number of managing agents did not appear to be accounting for VAT correctly on their management charges. We approached a HMRC policy team, and after some time they agreed with us, and last September HMRC provided clarification for managing agents. There were no change of rules, but it was clarification of what the existing rules were. And as I say, the main point here is really many managing agents had not been accounting for VAT correctly on their management charges to landlords and resident companies. Indeed, a number of them are actually advertising their services as VAT exempt, which was clearly not correct. It's rather unfortunate that HMRC guidance and the extra statutory concession relating to residential management charges, and indeed some rogue rulings from HMRC officers, hadn't helped the situation and had caused a considerable amount of confusion. In fact, some of the guidance, unless you're dealing with VAT all day and every day, is quite unfathomable. Anyway, in last September, say, there was a lot of clarification came out, and the main problem area really is where the managing agent employs some staff on behalf of the landlord. So the managing agent maybe employs the concierge or the caretaker or the porter, and what had been happening when the managing agent recovered the salary costs of those individuals. Because of their interpretation of the guidance and the concession, they had not been adding VAT to the recovery of the salary costs, which in many cases was clearly incorrect. The view that HMRC take is it's only the party that holds the property interest, i.e. the landlord or freeholder, which is able to issue a service charge to residents on an exempt basis. Clearly, many landlords employ managing agents to do that on their behalf, but the point is that exactly that, they are doing it on behalf of the landlord. There is no property relationship between the managing agent and the tenants. So as I say, when the managing agent recovers their costs, third-party costs, their own overheads, plus any salary costs of the concierge and the porter and the caretaker, the total cost when it's recovered from the landlord should attract VAT. In practice, what happens is the managing agent issues the invoice for the service charge direct to the tenants, collects the money from the tenants, holds it in trust to pay away costs. But the legal contractual reality is the managing agent is doing that on behalf of the landlord, and therefore those kind of recoveries should all attract VAT. This has caused quite a furore in the marketplace for many resident management companies and right to management companies who don't quite follow or accept HMRC's treatment. So there's some ongoing discussions with HMRC policy, specifically around resident management companies and right to manage companies, and we're still waiting for some further guidance. But certainly third-party commercial residential managing agents should now be falling in line, and indeed the clarification provided last September requires those managing agents who have not got it right, so to speak, in the past, to correct their treatment with effect from last November. So anybody in this field should be closely looking at that guidance. I'll move on to VAT liability of post-completion works, which, and this is a point which I find rather surprising, HMRC actually have not advertised more widely. It arises, unfortunately, out of the Grenfell disaster and the requirement around the country now to review the cladding on a number of high-rise developments. The point here is that it was generally expected that the costs of the replacement cladding would all attract VAT. So I think many VAT advisors were somewhat surprised when HMRC announced that in certain cases the replacement of cladding could be treated as zero rated. Any post-completion works on residential developments would normally attract VAT at the standard rate, with the exception of snagging. But in this case, and I suspect there was a fair amount of political pressure brought to bear, but HMRC now accept that provided the works are carried out by the original developer, zero rating may apply. Now this is an important point because obviously up and down the country there are a number of high-rise buildings where the cladding at very high cost needs to be replaced, running into millions. And the point is whether the original developer is still there to incur those costs, whether they would wish to incur those costs, or indeed whether tenants, obviously, who will find the cost passed on to them as part of their service charge, can fund those service charges. So it's quite an important point, and the ability to zero rate the replacement works for cladding will lead to considerable savings for developers and tenants. An interesting point here is that the principle is that provided any rectification works that are undertaken post-completion are considered to be so material as to question whether anybody would have considered the building as complete at the time of PC had they known about the problems, leads to the it does tend to establish a principle that any material works of rectification post-completion may also benefit from zero rating. So I think it's something for developers and contractors to think about. There was a case concerning a replastering of the house where the plaster work was considered to be so faulty that nobody would have considered it to be complete at the time, and the courts held that the replastering, albeit after completion of the family had moved in, could be zero rated. So I think there's quite an important principle there in relation to some post-completion works where zero rating may still be possible, which would result in a saving both for the developer and the tenants. Just moving on to VAT and white goods, which is an area we do a lot of work on. White goods here, generic term for things like carpets, fridges, freezers, washing machines, etc., but also other areas such as vanity units, etc. And in this case, a developer cannot recover the VAT on the white goods that a contractor charges to them. Unfortunately, HMRC guidance hasn't necessarily kept pace with time, and many items which are now ordinarily installed, particularly in mid to high level, high spec residential developments, have moved ahead of HMRC guidance. And it's certainly worth looking at some of the items that are installed and asking whether these are items which are ordinarily installed or whether they fall under the white goods category. Unfortunately, a number of contractors, and apologies to any contractors who are listening, but many contractors will not necessarily spend the time to identify white goods. There's nothing in it particularly for the contractors. They charge the VAT to the developer pays it, the contractor pays it onto HMRC. So there's nothing in it for contractors to spend time splitting out white goods or identifying white goods. And importantly, splitting out installation costs, because installation costs of white goods for new build residential also benefit from zero rating, or indeed in conversions where the 5% reduced rate applies, can benefit from 5%. So it's very important that any developers of new build resi do actually look at the spec, identify correctly the items that fall under white goods or do not, and have a discussion with the contractors to make sure the VAT accounting is correct. Because for a developer, for every £1 charged in relation to white goods, that £1 is irrecoverable and goes straight to the bottom line. And it is possible to make some material savings, particularly in some of the high resi developments, where, say, the fit out includes items which are challengeable as to their status as white goods or not. Moving on to the next item, which is the reverse charge in the construction industry, which is due to be introduced with effect from the 1st of October. HMRC have been in discussions concerning the reverse charge for over a year now. There's been a number of teething problems and issues arising as to nailing down the legislation, but essentially we will see a reverse charge introduced with effect from the 1st of October. It's in line with the steps taken by a number of other EU countries, and is there in order to cut down on the considerable amount of fraud which exists within the construction industry. So typically where you have a large building site, you will typically be a lead contractor, but there will be any number of subcontractors, some of them very small. And the incidence of fraud with contractors charging VAT and not paying it over, or phantom companies being hijacked by criminal gangs, etc., is quite high. And this is something that the HMRC have decided they need to crack down on. And the obvious way to do that is to introduce a reverse charge, because this stops large sums of VAT moving around the system and failing to be reported or paid over to HMRC. The essence of the reverse charge is that each contractor in the supply chain will raise invoices, but there will be no VAT charged on those invoices, and the contractor who receives those invoices from the subcontractor will effectively apply what's known as the reverse charge, which basically means charge themselves VAT and recover the same amount of VATs. So the reverse charge is in fact VAT neutral, but what it does do is, as I say, stop large amounts of cash in the system, which is the subject of fraud. All that's required is an entry to be made in the contractor's VAT returns. And this reverse charge flows all the way up the supply chain until we reach the lead contractor. and the lead contractor will issue their VAT invoice in the normal way to the end user and charge VAT. And the VAT will pay to the contractor, and the contractor will pay it in the normal way. What's quite important in this case is that the legislation requires the end user, so this will be the developer who is now going to sell the apartments or sell the office block that's been built. It requires the user to certify their status as an end user to the lead contractor, which basically says, we are the end user, we are onward supplying your construction services, therefore you have to charge us VAT. There's potentially some issues here because many small businesses, particularly charities and the like, will be blissfully unaware of these rules and may not recognise the need to certify themselves as end users, which means their contractors may not charge them VAT, and they will be unaware of the need to apply the reverse of the need to be charged VAT, and VAT will not be accounted for. HMRC have said that in this case they will go after the end user, i.e. the person who's failed to certify their status, and look to recover the VAT. So you can foresee a number of issues here, and it's questionable as to the vires or the powers that HMRC have to go after an end user, because VAT is basically a self-assessing tax, and the requirement to get VAT right is on the supplier of the service of the goods rather than the consumer. So it'll be interesting to see how that will develop. There are a number of other issues arising. The statutory instrument was published about 10 days or so ago. It talks about specified supplies. It lists the kinds of supplies that are caught by this. Essentially, it relates to supplies which are subject to CIS, the Construction Industry Scheme reporting. It doesn't apply to employment agencies, so employment agencies employ labourers to work on sites are outside the rules. But I think it will be worth looking at. There is a detailed guidance note which is still being drafted by HMRC, which hopefully will come out soon. But the main thing for contractors in the supply chain will be to make sure your IT systems, come the 1st of October, will be capable of dealing with these changes. So 2019 is quite an interesting year for the IT world, because there are obviously a number of changes. We've had Making Tax Digital. We will have these changes coming through in October, which will all require tweaks to the IT systems. My last point is around barter arrangements, and this is a general point really. HMRC have this view of property transactions being generally quite straightforward and simple, and they're quite easy to analyse. In my experience over the years, I've never yet come across a straightforward property transaction, and many transactions involve both seller and buyer in some kind of barter element where there's a trade-off of some sort. So in my slide there I give two examples where a seller takes a reduced consideration from a buyer on the basis that the buyer will develop a site and hand back a long lease interest over a ground floor retail to the seller. I've seen this happen in a number of occasions, particularly in the housing association world. Another is where there is a land swap with a balancing consideration passing. There are many examples of complex arrangements which typically involve some kind of trade-off. And this can also get into an area particularly where refurbishments have been undertaken, where a tenant will pay for a landlord's refurbishment, which can also have added complications when we look into options of tax, which I won't go into today. For VAT purposes, the important point is that transactions need to be effectively grossed up. So we need to recognise that in my examples there are in fact two transactions in opposite directions, by seller to buyer and by buyer to seller. There is a trade-off, but for VAT purposes, as I say, it's important to recognise the transactions in a grossed up basis and account for VAT on a grossed up basis rather than the net position. The point being that, okay, if all parties are fully taxable, there's probably no loss of VAT to HMRC, but more often than not, one or other party may not be able to recover VAT in full. And if the transactions are not correctly recognised, that does result in a loss of VAT to HMRC. So HMRC will always analyse some of these complex transactions to make sure the VAT has been correctly accounted for. So in terms of wrapping up and key takeaways, I think the main thing is, as I say in my first box there, think ahead, plan ahead. Unfortunately, in many of my cases I come across, I find myself firefighting, i.e. HMRC have been in, raising a chunky assessment, claiming penalties, and so it's normally a case of firefighting and trying to unravel situations. I'd like to think most of my clients I've educated, if I can put it like that, in terms of thinking ahead. So the key thing I would suggest is, if you're involved in a project, at the very, very start, just pick up the phone, have a 5-minute chat about the potential implications. If the project goes ahead, then okay, we can have a more detailed discussion. But really, VAT is more than just 0%, 5% or 20%. There are a whole range of issues to recognise and which need to be thought about. The second point there, identify irrecoverable VAT, ensure it is budgeted for. This really goes back to the white goods point that I was talking about for new build resi developers. A number of developers, maybe not necessarily used to new residential developments, maybe more involved in commercial developments, fail to recognise that VAT on white goods is irrecoverable. Again, going back to what I was saying, if we can identify this at the start of the project, at least we know it's irrecoverable, at least we know we can factor it into the cash flows and where it's going to hit cash flows. So it's very important to look at the cash flows and the budgets. And my last point really is, are you correctly accounting for VAT? And that goes back to the last point on barter transactions. It's essential that at the very beginning the transaction is analysed clearly from the VAT perspective. If you start off on the right foot, then hopefully the VAT will follow on from the correct analysis and there will be no problems. But the introduction of the reverse charge is going to be important, and it's going to be important that VAT is correctly identified and recognised and accounted for through the VAT returns. And as I say there, with barter arrangements, it's essential that the transactions are correctly analysed from the start in order to ensure that VAT is correctly recognised. I think that's really all I wanted to say, so I'll hand back to Zoe. Zoe, I mean, I was sort of looking through and listening to you talking on your point. I mean, there are a number of changes that have taken place in direct tax world on property in recent years, you know, whether it's SDLT or corporate tax. I mean, what is the main driver for HMRC to bring all these changes in the property sector? I mean, it's impacting the property sector, but there have been a number of changes in the last couple of years. So what's the main driver here?
Hi, John. Thanks. Yeah, you're right. I think a lot of people in the property world are thinking that they are being hit unfairly, and what HMRC and I suppose the Treasury are trying to do is to make the non-residents on a level playing field with the UK residents. So I suppose land is a national resource, and as an island it's quite limited. We don't have very much of it, and consistent with international tax rules, the primary taxing rights over income and gains go to the state where the land belongs and also where the immovable property is located. Until April this year, the UK didn't actually exercise its full taxing rights in that respect. So anyone that was a non-resident didn't actually get taxed on capital gains when they made a disposal of a property or some land. So what the UK revenue are trying to do is to put changes in place which more closely align the tax treatment for non-UK residents to that of UK residents. So that's reducing the incentive for any multinational groups to hold UK property through offshore structures. Often they do this in low tax jurisdictions or no tax jurisdictions, and just making sure that UK residents are treated fairly with non-residents. And I think it's going back to that, I suppose, the whole ethos of making sure that we are all paying our fair share of tax, and that is, I suppose, being seen more widely throughout the tax world at the moment. So I suppose that's the key message that Revenue and Treasury want to get across.
I mean, how do you see this impacting on the sector? I mean, have you seen a slowdown in activity, or?
Initially we did, but interestingly, I'm still seeing a number of transactions, certainly in the major cities, still going ahead. So I'm in Bristol a lot, so I see a lot of transactions going on in Bristol and London particularly. So I thought with Brexit and also the recent changes in the tax law that there would be a number of kind of transactions being put on hold or the prices changing. There has been a slowdown, but it certainly hasn't stopped the market.
Yeah, I mean, I think London tends to be a bit of a bubble in terms of the property market. It's got a sort of particular status, but as you say, Brexit, well, it's clearly had some impact, but possibly not as much as we all felt. I mean, there's still a lot of cranes up on the London horizon. There's still a lot of work going on, so that's quite interesting.
And in respect of the VAT, I mean, VAT always fascinates me because, as you say, it's quite complex and there doesn't ever seem to be a logical answer. But in relation to analysing irrecoverable VAT on white goods, how proactive do you think contractors are in working with developers?
In working with developers, I think they're quite good. Unfortunately, as I say, with apologies to any contractors listening in, the developer does need to nudge the contractor, I think, in order to carry out a clear analysis of the spec. I mean, the development through, when we're talking about essentially here new build residential, so the developer through to Shell and Core will typically be zero rated. It's when you start the fit out, and it's important that in advance of that work that somebody does a detailed analysis of the spec. So, for example, typically a spec might say vanity units. Now, saying vanity units is red flag to a ball as far as HMRC, because they will immediately say that attracts VAT, which is irrecoverable for the developer. But when you analyse exactly what is in that heading vanity units, quite often you'll find a whole range of other things which do not fall within the white goods. So that it might include some casing which covers hides pipes and pipe wear. It might include a mirror as well. So a lot of these items do need to be clearly analysed, and I think the important part, particularly the one where the quick wins are making sure contractors analyse out the installation costs. Because as I said earlier, the installation of white goods still qualifies for zero rating or 5%, the reduced rate, where we're doing work to converting number of units or empty property being brought into use. And those are big wins. And typically, when we run our eye down a building spec, we can mark that up to say where we think that should or shouldn't be charged. Most contractors will normally accept that, and significant savings can be made. And as I say, it goes straight to the bottom line, because every pound of VAT on white goods is irrecoverable for the developer. So it's an exercise worth undertaking.
And as I've seen something similar with R&D, you have to do it at the time, because if you don't do it at the time. Yeah,
I think ideally you would always do it in advance, because ideally you want to sit down with the contractors, produce a report, get them to buy into it and agree to it, and then the invoicing can go ahead on an agreed basis. The problem with when doing it after the event, when the invoices have all been issued, is it becomes much more difficult to unwind everything, and it just becomes more tedious and more time consuming and more costly. So sitting down with a contractor up front is absolutely essential in my point.
Okay, agree. We've just had one question in, how do the tax changes affect commercial property? They do affect commercial property. All property is affected and caught by the new legislation which came in a few days ago. So from the 6th of April this year, all UK property is now within the UK tax gain. So any property, whether it's a warehouse, a factory, a retail site, whether it's residential, all will be chargeable to capital gains tax.
The only thing I would go is just emphasise, going back on the reverse charge of the construction industry, is to make sure those involved in the construction make sure your IT systems are capable of dealing with the changes which are due to come through in 4 or 5 months time, and make sure you can pick up where the reverse charge does or does not apply. I think relying on the end user, particularly if you're dealing with smaller developers or businesses, is possibly not necessarily a recipe for disaster, but a number of end users will not be aware of the rule changes and will get it wrong. So I think there is a certain onus on contractors to make sure that they advise their clients of the rule changes. So as I say, I think there's probably a bit of IT thinking that needs to go on there as well.
Yeah, I agree. And as you say, VAT and IT are intrinsically linked to this, aren't they? Okay. I don't think we have anything else that we wanted to cover, and we haven't had any more questions. So I think we'll wrap up the session now. So thank you very much for listening.
Thank you.